This is the current federal tax developments for the week of September the 8th, 2025. Current federal tax developments are brought to you by your state society of CPAs. Med Zollers, and we're doing this week's broadcast from here in Phoenix. What we're going to look at this week are a few cases. First one will be from the 11th Circuit, cases under development, I should say. But the first case is from the 11th Circuit. This is going to be a gross valuation misstatement penalty in a conservation easement case. Now, unlike most of them we've talked about before, this will not be a marketed package where they went out and bought this property and magically it exploded in value within a year. This is a longer term holding and not really a marketed concept. So this is just a standard partnership trying to take advantage of the conservation easement. We're going to discover they're going to have the same problems that some of the others did in terms of the valuation was deemed not reasonable. But again, a little bit different here. We're also going to talk about IRS guidance this week. Well, it's kind of leaked out is apparently what happened, where they've developed a preliminary list of the occupations that will be considered eligible for the qualified tips deduction. So we're going to have these tipped occupations list. And it's an interesting list, and it includes some occupations that may surprise you a bit. So we'll talk a little bit about that. Next, we're going to talk about the 8th Circuit got its second swing at the dispute between Medtronic and the IRS on a transfer pricing dispute. And this time, the 8th Circuit will again send the case back to the tax court. But in this case, they've effectively handed the IRS a win on their position. We'll talk about a state tax case next, and that's from California's, Office of Tax Appeals. And this looks at an entertainer who is claiming not to be a California resident. And we'll talk about how the state, why he was determined to be a California resident and the types of things that the state considered most significant in arriving at that position. And then finally, we're going to talk about a bankruptcy case. And it's going to be from the bankruptcy perspective, but it does involve the tax issue. And this will be the IRA bankruptcy exemption. In this case, we're going to have basically a debtor who had inherited an IRA from her father, and she, instead of, basically it was an inherited IRA, and as we'll, discuss with Supreme Court decisions, basically inherited IRAs don't get bankruptcy protection, but she claimed that this account should now be protected because she had cashed out dad's account and then, quote unquote, rolled it over to an IRA account in her name. Now, as you probably are thinking right now, I think she has some problems. And yes, she has some tax problems, without question. But she's also going to have some problems here with regard to the bankruptcy exclusion. So we'll talk a bit about that case. But let's go ahead and go to our first case we have here. Now, this is the 11th Circuit Court of Appeals that upheld a 40% penalty in a conservation easement case in the case of Buckaloo Farm, LLC versus Commissioner. This is a case number 24-13268, and the 11th Circuit's opinion came down on Tuesday, September 2nd. Now, Buckaloo Farm, LLC was a partnership which was formed by former Major League Baseball players Ryan Klesko and John Smoltz. This is not a marketed thing. That's probably the first starting point we have here, is we're not talking about one of these things where the partnership was something thrown together to acquire a piece of property that would somehow magically go up in value by a huge amount within a year, after which they'd give a conservation easement. And everybody gets this huge deduction that gives them a tax benefit way more than what they put into the partnership. And all is well, at least till the IRS shows up. This case, they're going to have claimed a $47.6 million charitable deduction for a conservation easement on property they had purchased years before for about $4 million. Now, the IRS disallowed the deduction and assessed a 40% gross valuation misstatement penalty. The tax court, when it made its final decision, it allowed a deduction of $4.6 million. That was based on the IRS's experts' valuation of the property, but they did uphold the 40%. So they didn't have a total disallowance of the deduction, but rather what we had here was a great reduction in what was there. And because of how much less it was than what was claimed, they upheld the 40% gross, basically gross misstatement for valuation misstatement penalty. So again, the tax circuit's decision was affirmed, and the 11th Circuit also sustained the penalty, which is, that penalty is a substantial amount. And as we've discussed before, that is a penalty that cannot be waived for reasonable cause. So it doesn't matter if our players sought and obtained competent, advice, and they were advised that that particular amount was, perfectly acceptable, and they had no reason to believe it wasn't right. They still can't get out of that penalty, right? That particular penalty does not have reasonable cause exception, which is a big thing to remember whenever you have a client looking to get into that sort of thing. It's like, well, that's great, but if you lose it, you're not just out the tax. You're going to basically pay the tax and an additional 40% on top of that, because it doesn't matter that you sought advice, did everything in theory that you should have done. That they're wrong. They're wrong. They're found to be wrong by enough so that you overstated your deduction by a significant amount. And again, in this case, we're talking about they overstated it by effectively 10 times. That's way over the limits for getting the max penalty. You end up with a 40% penalty. If it's not quite as aggressive, you get a 20% penalty. So if it's 200%. As I recall, it's 200% is the 20% penalty. So if the actual value claimed is 200% of what is more than 200% of what is determined to have been the real value, then you get the 20% penalty. If it's determined it's more than 40% of the actual value allowed, that's when you get the 40% penalty. So again, you could, let's say your benefit from this was whatever that number might be, $20 million was your benefit. You're going to pay not just $20 million plus interest. You're going to pay $28 million, right? You're going to pay basically 40% additional. So effectively your tax goes from 2028. So yes, there is something to lose aside from the interest by undergoing this transaction. So clients need to understand that about the risks of these transactions where the valuation maybe seems a little high. You might want to do it. And by a little, I don't mean just a little. Seems like quite high. We'll get into that. So let's kind of take a look at this case and what was going on. Right. So the taxpayer's valuation said that before it was given, and what you do it before and after when it's a conservation easement. What's the property worth right now with no easement on it? And then after the easement, which does not allow a buyer to do certain things, right? Takes that away from the buyer. What's the property worth after you've made that easement? Now, the problem fundamentally that begins to be why these don't sound good when the numbers are so big. In this case, he's saying it's worth $50.48 million. But afterward, we're going to get rid of this. And remember, once we do that, we're going to essentially get down to a contribution that's 47.8. So essentially, we are going to, we could sell it today, apparently, in theory, because this is supposed to be a value that would be between a willing buyer, willing seller, neither one under compulsion to, buy or sell, and both fully aware of all facts. We could have gotten $50 million, right, in our pocket. But we are going to do this, give up basically 47 million of it, and then go around, and then we could sell it for $3 million. And you begin to wonder, why would you do that? Even with the tax consequence of, when you sell it, you'd pay tax, you're still giving up a huge amount of money in your pocket. So unless you are somebody who has, just an extreme reason to want to, give this contribution, it seems a little tough to buy the theory. Now, if the easement is a smaller percentage of the value, and we're fine with that, and it'd be a good thing about, if you're giving up $1 million on the $50 million of value, then maybe it's a little bit easier to accept. that, okay, that's it. These guys have net worth. They're giving up $1 million. They're still got 49 in pocket, less the tax. So that's what always makes these difficult when the easement becomes like a huge proportion of the property. And it raises a second question almost immediately is why don't we just give the whole thing away? At that point, it's going to be worth so little. But in any event, our valuation was $50.48 million. Now, according to the expert, the valuation, which is how you're supposed to do it, is based on the highest and best use of that property. And the appraiser determined that highest and best use would be a proposed 307-lot luxury residential community. Okay, that now, it didn't currently have, it's a farm right now. It does not have any of that on it. Now, one of the key issues you got to worry about when you're going to say, well, the best use is something that's not being used for now is it even legal to do it? Now, on the legal permissibility, they supported that by the zoning director's letter that said it was more likely than not that this development would be approved by the relevant, locality. So they would approve it because obviously, if you're not allowed to build a 307-lot luxury residential community because you couldn't get zoning approval, then that's not the highest and best use because that's not a possible use. So the problem became, though, was it was determined that letter had been obtained from the zoning director without discussing key details like there would be gravel roads, not paved roads, and there would be a community septic system. That's the type of development they felt was possible there. And, they never disclosed that they wouldn't do all the other stuff. And once the director was informed of this, he testified at trial. Had he known about the gravel road and large-scale community septic system, that letter would never have been issued. He would have cited public safety and regulatory hurdles that essentially would have said, we're not going to approve this, right? That this thing could not go forward. Now, the other problem was, and probably a bigger one in this case, was that the appraisal used a discounted cash flow analysis, not comparable sales of similar property, because the appraiser couldn't find any. Now, you may know that this has been continually the problem. In recent cases, the tax courts made it very clear they do not like the discounted cash flow analysis of a theoretical but not currently existing, operation on the property. And there's lots of reasons they don't, but they're saying that, come on, that doesn't exist right now. That is getting way out into the realm of speculation. Clearly, what would make a lot more sense is if, let's say, a nearby property, you could find a comparable property that had been sold recently, and that was sold for, around $50+ million. Okay, because these theoretical developments are what the court gets very skeptical about very quickly. So the discounted cash flow model used lot prices from high-end resorts in entirely different markets. So that was a problem, right? They said it wasn't comparable at all. There was nothing nearby. And the court, not a fan of that. And, we've talked about these cases earlier in this year. It's clear they're not a fan, right? It's going to be an uphill battle to get the tax court to buy a discounted cash flow analysis. So what the tax court said was that there were two reasons. We kind of discussed this. The court had serious concerns about whether this was legal, right? In essence, you would not have gotten zoning permission to do this. So you wouldn't have been allowed to build those lots that in theory you were going to sell. Or, basically create those lots because you wouldn't have been allowed to do so merely doing the things you were talking about doing, which were all key to part of the discounted cash flow. And even if it was legally permissible, the second problem was that the valuation was not financially credible. The IRS experts did identify comparable sales that they could tie much closer to the local market. The tax court found those much more persuasive. I mean, basically, it's like here are comparables in comparable areas, and this is what they were selling for it. It was not going to get you near $50 million on this, right? The IRS expert, Mr. Ryan, showed the local market was weak and that property itself was not ripe for development. The court said the claim value in the taxpayer's appraisal of $32,600 an acre was a fantasy. In the words of the court, that's never a good word for the court to have said about your valuation, that your value number is a fantasy, because the court said comparable properties had sold for between $1,600 and $5,000 per acre. And obviously, even at $5,000, that's significantly below $32,600 per acre, which is what the taxpayer's appraiser was saying. Now, obviously, the key thing here, come on, there is a pattern. I've already noted it. Your appellates, basically, the fatal error was, the tax court affirmed the tax court's decision on the second independent ground. It was an unpersuasive valuation. The format of fatal error was failing to challenge this factual finding on appeal. They waived the argument. That was a mechanical flaw in what they did. They also, but we note, right? So what the appellate court said is it didn't matter about anything else. You never challenged the fact the valuation was out in left field. You never produced additional evidence. So, come on, I got nothing to overturn the tax court based on what you've given me. So essentially, they didn't raise it. And it's too late now, guys. You can't come into the day we're going to argue and suddenly start trying to do that. Note that appraisals must be based on credible comparable market data. Gang, we have learned the tax court is not buying discounted cash flows on speculative plans, right? And they do not like non-comparable properties, right? They're going to say, don't tell them you can't find comparables. They're probably not going to accept the line. Again, when people are trying to aggressively value these easements, this theoretical development that nobody's done is what tends to be used. And like I said, the court it's going to be difficult to sell, especially if nobody's done it. And because the court's going to seriously ask, well, what sane person wouldn't have just sold to the person for $50 million that was going to do that development? Why wouldn't you have sold that way? Well, right, it's tough to answer. And, that they said, argue about the admission of a tax return amended fraud claim were irrelevant, right? Because that's it. Because what they said was, this was issues, right? But those, they admitted the tax return of one of the partners, and there was an amended fraud claim here. But the court said, we already gave you the fraud, right? The tax court did not find you'd committed fraud. So regardless of whether or not the tax court fouled up procedurally by admitting the tax return of one of the partners, or had allowed an amended fraud claim to be made by the IRS at trial, you weren't held to have committed fraud. So in essence, there's nothing there. We can say the tax court was wrong on letting both of those in, but if we did that, all we'd do is throw out the fraud penalty they would have imposed, which they didn't impose anyway. So tough luck. So, the court confirmed the evidentiary and pleading issues are subject to harmless error review, not the high standard of whether it was a structural error. So yeah, they found the tax court essentially, any errors that were made were harmless errors, and it was not something they had to go beyond. Okay, next up, we got some information this week on qualified tips. That is, the Treasury and the IRS released a preliminary list of tipped occupations. The title of this paper, which is available on the Treasury's website, is Occupations that Customarily and Regularly Receive Tips on or before December 1st, 2024. This was released by the Internal Revenue Service. It appears September 2nd, but the actual document was created the week before. Now, how this came to be known was essentially Vox reported it, basically the week before that this list was there. Other outlets began getting the same information, picking it up. For instance, Tax Notes Today on their edition that was published, in this week. They also noted that, this was here, it was real, and this is a list. Now, it is preliminary. That's what's important to understand. Whether the IRS really intended to release this week, or whether it's just, hey, the genie's out of the bottle, let's just go ahead and get this thing officially out there, is tough to know. But in any event, we do have some ideas of what will be tipped occupations under this rules. So this is our initial, even though it's tentative, guidance on occupations that qualify for no tax on tips deduction. An official proposed list is going to show up in the Federal Register for public comment. But they do note on here that it is expected to be substantially the same as this preliminary list. Now remember, the reason we need this list was Congress said that to claim this deduction, a worker's tips must have been received in the occupation that customarily and regularly received tips on or before December 31st, 2024, and they charge the IRS with coming up with that list. So this is most likely very, very close to the list. There are a couple of other caveats about this list, one of which is there are some language in the statute has excluded occupations, or, things that could be excluded. So some of these may have portions, or some people in the occupation may be in excluded categories. So they do say they're going to have regulations, going to comment on that too. So don't go overboard with this list right now, but this list does give us an idea of where things are going. And it's important for two different reasons. Reason number one, obviously, if you have an individual client that works in one of these occupations and receives tips, then yeah, we need to know they're going to qualify for this. But number two, if you have a client who, let's say, is a business client of your firm, and that client has payroll, they're going to be required to report the qualified tips. Now, that won't be on this year's W-2, but it will be on the 26th W-2. And IRS is supposed to develop some methodologies that can allow the employers to, give employees a estimate of the proper number for 25 that they can rely upon for the return. So your clients in these industries need to realize, or who have employees that do these occupations, need to realize that there's a payroll reporting issue that they need to be aware of. And again, when more occupations get added to the list, that's when, of course, we have, some people that weren't expecting may end up with this. Oh, and by the way, it also does have, I skipped by that here, the Treasury tipped occupation code. That is, what they referred to on the W-2. Remember, the draft W-2 for 2026 has a box for the Treasury tipped occupation code, TTOC. That is on this list as well. Now, the list is organized into 8 categories, right? Those categories are beverage and food services are the first, entertainment and events, hospitality and guest services, home services, personal services, personal appearance and wellness, recreation and instruction, and transportation and delivery. Those are the categories. Within each category, under each category, they will list the specific occupations in that category that qualify for the tip deduction. Okay. Now, this list was developed by referencing and modifying the 2018 Standard Occupational Classification SOC system to better reflect which specific jobs, basically receive tips. So they use that guide, which I believe is Department of Labor runs that one, and they use that and then work from there. Now, the department, the OBB, basically Act itself carves out certain fields. Tips received in the following trades or businesses are not eligible for the deduction, regardless of custom, and that includes health, performing arts, and athletics. This is where it's going to get a little more interesting because it appears, the IRS says, this list includes some occupations where certain of those who might fall into that category are going to nevertheless have overlap with the barred categories. And there's going to be guidance about that in the proposed regs, right? So there's going to be additional additional guidance in the future. So let's talk about what some of these occupations are. And I do suggest you download the list. We do have the link. It's basically in our, it's going to be, we should have the link. It is inside, it's on the website. So you want to go to our website, currentfalltaxdevelopments.com, go to this article about this. You'll find it. You can probably search for it now, too, under that title. Right, occupation that customarily and regularly received tips on or before December 31st, 2024. At the time I wrote up the document we're using today, or the PDF, that had not been posted on the IRS website. Finally, we found the link internally where the website had it, so I didn't just have the copy I had read off of tax notes. So that's where you're going to go find that right now. So what are these occupations? Okay. Well, in food service, we have bartenders qualify, wait staff. That basically includes not only in a restaurant, but they have things like a dining car server would qualify. Food servers outside of restaurants, so that means like room service, food service at your hotel, a boat hop, a beer cart server. Dining room and cafeteria attendants and bartender helpers. So that'd be people in the back bar, a bar helper, somebody who busses tables. All of those would go. Chefs and cooks are in there. So we could have that. And other food preparation workers, salad makers, sandwich makers, fruit and vegetables parer, kitchen steward. Fast food and counter workers qualify. You're seeing more tips there. So like your barista at Starbucks, there's tips there. Those tips to Starbucks baristas will count for the exclusion, right? Ice cream server, a cafeteria server. Dishwashers. Again, now in a lot of restaurants, you're going to have pool tips and you're going to divide them among all of these service categories. Also host staff, restaurant, lounge, and coffee shop. Maitre d', in this case, a dining room host, and bakers. A baker qualifies as well. So those are in the first category. We also then have for entertainment and events, gambling dealers, your blackjack dealer, craps dealer, poker dealer, roulette dealer, and pit clerk. Also gambling change persons and booth cashiers. If you tip the person at the change booth, right, or the cashier, slot attendants, mutual teller, those can qualify with tips. Also gambling cage workers, they're casino cashiers and cage cashiers. Casino and sportsbook writers and runners, so the betting runner, a bingo worker, a keno runner, a racebook writer, etc. Dancers. Now again, this is going to get more interesting because one of the excluded occupations is performing arts. So we're going to get into that, but nevertheless, club dancers and dance artists, musicians and singers. Again, watch out, there's the overlap category here. But instrumentalist, accompanist, lounge, basically a lounge singer, a disc jockey except for radio. So a DJ, a club DJ, but not a radio DJ. Sorry for that. Entertainers and performers, that would include comedians, clowns, magicians, street performers, but not in performing arts. That gets like, okay, that's going to be weird. Digital content creators is one that probably you hadn't initially thought of maybe, but you do. If you're a streamer, online video creator, a social media influencer, a podcaster, in many cases, you've got things like on YouTube, the super chat option, which is essentially tipping the podcaster or the video, the producer. There are various ways that they could do it. So if they get tips, that'll count toward this exclusion. That's interesting. Obviously, subscription revenue would not count, but tip revenue does. That's interesting. That category's there, but it will be there. Also, ushers, lobby attendants, and ticket takers. So that's there. Also, locker room, coat room, dressing room attendants. They're in there. For hospitality services, a baggage porter and a bellhop. Concierge count for this. So guest service agents, activity concierge. Hotel, motel, and resort desk clerks count. So they can get it. And maids and housekeeping cleaners would count in that category. For home services, we have home maintenance and repair workers. A handyman, a roofer, a window repair, house painter. That could be interior, exterior, or a floor installer. Would qualify for that. Now, that could be interesting. I don't have anybody now in that. I used to have clients in multiple categories that would have that. And that, in essence, they now could be facing a situation where, if people are tipping the floor installer, in theory, the installers are supposed to report that to their employer, and that's to be reported as a qualified tip on their return. So that gets kind of interesting. Groundskeeping and landscaping workers, right? All of these things. That would be like a lawnmower, a gardener, a tree trimmer, a weed sprayer. Home electricians. Do you tip your electrician? That's going to be the issue. Or plumbers. Plumbers count too, along with pipe fitters, steam fitters, sprinkler installers, heating and air conditioning mechanics and installers. You're tipping them. Home appliance installers and repairers. Home cleaning service workers, house cleaners, pool cleaners, carpet cleaners, and a window washer. Locksmiths. Yeah, they finally get you back in your car. So if you tip them, that'll count as this category. And roadside assistance workers, tow truck drivers, battery technicians, tire repairers, tire changers, and a car fuel deliverer could be in there. Personal service, personal care, and service workers, and some of our examples are an elderly companion, a personal care aide, a butler, a house sitter, or a personal valet. Private event planners, wedding planners, party planners would qualify for this. And a private event and portrait photographer. So a wedding photographer, a headshot photographer. Videographers also, right? So if you're not having the photographs, but you're videoing it, you got somebody to do that, then the wedding videographer would qualify for this as well. An event officiant, the pastors at the wedding ceremony, right? That would include wedding officiants, funeral celebrants, clergy, vow renewal officiants, to the extent they are tipped. I can just see some interesting thoughts working there in certain places. We'll get into whether you tip your clergy. Oh, yeah. I see the litigation already setting up. Tax court cases are coming down the line. I can see that happening. If you have a pet caretaker, so if you're tipped for being a pet groomer, a pet sitter, a pet walker, a kennel worker, or a pet trainer, then that counts. Tutors. If you tip your reading tutor, your math tutor, your language tutor. Nannies and babysitters. So au pair, the child sitter at hotels and gyms, all of those things, they're tipped. They would end up picking it up. Under personal appearance and wellness, a skincare specialist, right? So a facialist, electrologist, and a spa esthetician. I like that. Massage therapist. The masseuse, deep tissue massage therapist, and sports massage therapist. Now, again, we got to kind of start watching on the health side here, so that's where it gets interesting. Barbers, hairdressers, hairstylists, and cosmetologists. That would include wig stylists, is one of the example occupations they give. Beauticians, hair colorists, hair cutter. A shampooer. I guess they felt it wasn't clear on the previous category. So that would be a scalp treatment specialist and a shampoo assistant. Manicurist and pedicurist, nail technician, fingernail sculptor, nail painter, an eyebrow threading and waxing technician, okay, so an eyebrow waxer, a makeup artist, right, wedding makeup artist, a party makeup artist, an exercise trainer and group fitness instructors that get tipped. That would include aerobics trainer, a yoga instructor, a personal trainer, tattoo artists and piercers. Oh, the younger crowd will like this, right? Tattoo artist, ear piercer. Actually, it's not younger anymore, right? I remember the days when it's like, man, the kids are all getting tattooed these days. Well, they become kind of lifetime things, and now those kids are like 40 years old, so it's like, yeah, it's not really the kids anymore. A tailor. So you have a tailor, a seamstress, a clothing alteration worker. You tip them. That counts. A shoe and leather worker and repairer, a cobbler, or a shoe shiner will qualify. And for recreation instruction, we got a category there. Golf caddies are in that category. A self-enrichment teacher. Now, this is an interesting category. It's got to be somebody who, and the description is, teach or instruct individuals or groups for the primary purpose of self-enrichment rather than for an occupational objective, educational attainment, competition, or fitness. Okay, watch the carve out there. There are carve outs. Because otherwise you start reading this and saying, well, a knitting instructor, a piano teacher, an art instructor, a dance teacher, you start thinking, hey, wait, CP instructor. No, not going to work. Neither does third grade teacher. So I thought I'd let you know that those, I don't care if you do tip the third grade teacher, it's income non-deductible. It's not going to be a deductible one. But if you tip your third grader's piano teacher, that works. It's kind of interesting. So we'll get there. Recreational and tour pilots, you tip your helicopter tour pilot, your hot air balloon aeronaut, your skydiving pilot. Yeah, I guess you got to tip him before you leave the plane, right? It's like, well, first thing, you're down to the ground, might not go right, so you need to tip him first. But secondly, yeah, he's going to be in the plane. You're going to be on wherever the area is you landed, and so you're probably going to be really close to tip him right, after you're done. So we'll get that. But anyway, we got that. Tour guides and escorts, so that would be a museum guide, a sightseeing guide, a travel guide, so like a cruise director or river expedition guide, a sports and recreational instructor. And again, teach or instruct individuals or groups for the primary purpose of recreation rather than occupational objective, educational attention, competition, or fitness. Be careful there. So I guess kind of reading that this morning. I was just watching the Formula One qualifying from Monza. So I guess if Max Verstappen, tips his basically his fitness guy, for getting him, ready to go, a recreational sports instructor, or any driving coaches. I doubt he needs to tip them. I doubt they're there. But if he tips any of those guys, or maybe the person in the simulator, I guess, yeah, it's not going to qualify. So we'll be there. On transportation, parking and valet attendants. Okay, makes perfect sense. Parking garage attendant, valet parker would be there. Taxi and rideshare drivers and chauffeurs, a cab driver, a personal driver, your Uber driver, all of those things. Shuttle drivers, the hotel, airport shuttle driver, hotel shuttle, rental car shuttle driver. Those people get tipped, so we do that. I know, I've done that one multiple times. I know that one. How about, do you tip your UPS delivery guy? Maybe, maybe not. But pizza delivery drivers you often do. Grocery delivery drivers, if you have somebody deliver groceries. Bicycle courier, the package delivery person. Now that's one like, do I tip the UPS guy? An appliance delivery driver or a furniture delivery person. How about a personal vehicle and equipment cleaner, the car wash attendant, auto detailer, or a boat waxer? Private and charter bus drivers, so motor coach driver, tour bus driver, a water taxi operator, and a charter boat worker. Makes sense that they would be part of that too and could do it. Rickshaw, pedicab, and carriage drivers, right? We're definitely listing every type. So a horse-drawn carriage driver, a bike taxi driver, right? Or a home mover, furniture mover, and packer. So that's basically the list. Now, as noted, there is that list of excluded items, right? That would be businesses not eligible for the deduction regardless of custom, or be, trades or businesses in health, performing arts, and athletics. So that's when we get to kind of the interesting area that some of these are going to have at least some people who you can argue are, in addition to doing what might qualify for tips, but they're in the wrong business or occupation, basically trade or business, even though they got the right occupation. So yeah, we have to watch that. The Treasury and IRS issue future guidance to clarify these exclusions. And that means, yeah, you got some people who are not going to be very sure if they qualify or not. That's just going to be the nature of it. Okay. Okay. Whoops. Yeah, we got that. So the performing arts exclusion, that could affect dancers, musicians and singers, entertainers, performers, comedians. Athletics could be exercise trainers and group fitness instructors. In essence, anybody in those fields, you got to kind of warn people that the final regs may change how this goes. Okay, next up, let's go one more time. The 8th Circuit, second time, remands the Medtronic transfer pricing case to the tax court. This is Medtronic Inc. versus Commissioner. It's from the 8th Circuit Court of Appeals, case number 23-2063, and opinion issued on September the 3rd. So let's talk briefly about this. The question and dispute on this thing that's been going on for a while now is the proper arm's length royalty rates for intangible properties licensed by Medtronic's U.S. parents to its Puerto Rican subsidiaries in 2005 and 2006. As noted, this is the second time the Eighth Circuit has vacated and remanded a tax court's decision in this case. That's why this is referred to as Medtronic 2, right? The first case is Medtronic 1. This is Medtronic 2. This has been run through on a couple of occasions. And I have a feeling whatever the tax court decides this time, we'll probably get another appeal. So we could see the Eighth Circuit picking this up a third time before we're done. Now, at issue in the appeals was the tax court rejected Medtronic's comparable uncontrolled transfer method, CUT cut method. They adopted the tax court's adoption of an unspecified method proposed by Medtronic and the tax court's rejection of the IRS's comparable profits method, CPM. As we'll discover, the Eighth Circuit will sustain the first rule that Medtronic's comparable uncontrolled transaction method was not proper, but they will reverse the tax court and remand on the last two. In essence, end of the day, they're going to say, in this case, comparable profits method that the IRS came up with is the method that should be used. And then they want to get through a factual determination related to that. That's where they do it. Now, the CUT method in the regulation requires the intangible property and controlled and uncontrolled transactions to have similar profit potential. The particular item here, the paysetter agreement, was not comparable. Paysetter's average profit margins was 29%, the agreement in question. Medtronic's was 54%. So there's a wildly different profit potential between, what they're using as comparables here, right? So essentially that was very, very different. Also, the paysetter only licensed patents, while Medtronic licensed a full array of valuable IP, including know-how, trade secrets, and regulatory approval. And the court clarified no adjustments basically are allowed. While comparability rules allow adjustments for circumstances, the regulation mandates that the intangible property itself must have similar profit potential. If it doesn't, that is an absolute bar to using this method. So again, basically the comparable uncontrolled transaction method has to have something with similar profit potential, or you cannot use the method. Okay. Now, the tax court had come up with this other method. They kind of invented their own. They use a non-comparable paysetter agreement as the starting point for its analysis. The court said any unspecified method must be based on information from realistic alternative to the controlled transaction. And they're saying, if the base transaction paysetter, which the tax court has held, fails the specific requirements of the method, CUT, it cannot be considered reliable data or realistic alternative. Once you had determined that paysetter lacks similar profit potential, which, by the way, the Eighth Circuit agreed with, basically, you couldn't use it to develop an alternative method or an unspecified method. So the court found right away that, tax court, you'd already ruled that this method was not comparable. It couldn't be used for CUT, so you can't go bring it back in when doing this. Rather, the court said that you need to reevaluate the IRS's CPM method. So it said you had rejected it based on incorrect legal standards. The tax court overemphasized product similarity. The Eighth Circuit said that is less critical for the comparable profits method than it is for CUT. The tax court failed to make specific findings on the differences in asset basis or functions like R&D and whether adjustments were possible. The tax court rejected the IRS's proposed adjustment for risk without first quantifying the actual risk borne by Medtronic, Puerto Rico, and the comparables. So the tax court must now make detailed factual findings on these points and apply the correct legal standard for CPM. And I guarantee you, as I said, whatever the tax court decides, one or the other party. And remember, in this case came to the Eighth Circuit because both the IRS and Medtronic appealed the case. Obviously for different reasons, but they appealed the result. So yeah, we're likely to see more things come up in this in the future. If this is an area that you're involved in. I don't do a lot in this area. I do very little in this area, where we're going to work about that for transfer pricing. But if you do, keep an eye on this because, yeah, we're getting more and more things coming in. But as a practical matter at this point, this seems to be a likely win for the IRS. So we'll go down that path. Okay, let's talk about how you determine if you are a resident of the state of California. This is the matter of the Consolidated Appeals of R. Peters, the Office of Tax Appeals, case number 22019-564, opinion released on September the 4th. So this is an entertainer that's been deemed a California resident by the Office of Tax Appeals. Now, let's talk about the basic case here. R. Peters, and they don't normally give first names, so we'll talk about Mr. Peters here. He was an entertainer that even though he's Canadian, he had significant ties to California, Nevada, and Canada. Okay. Now, the Franchise Tax Board had determined he was a California resident for 2012 through 2014. And because of that, they assessed him over $2.1 million in taxes and interest. Now, the taxpayer said, no, I'm domiciled in Nevada. So I'm a Nevada resident, and I only need to pay to California income on my income derived from California sources, which would make a significant difference. And he said, look, I have a Nevada driver's license, I have Nevada business entities, and I do have a home in Henderson. Now, the OTA sustained the Franchise Tax Board determination, finding that he was domiciled and resident in California. He's going to find, while he is correct about those three facts being true, nobody said that they weren't, that he had a driver's license in Nevada, he had business entities that were formed in Nevada law, and he had a home in Henderson. They're saying there are other facts you're not mentioning here that override that pretty quickly. So let's go ahead and look at this. Domicile. Domicile is that weird old common law theory about what is your permanent home. There are many ways to explain it. The best way I've heard explained is it's like, where you are, from, what is home, in the sense that even if you're away from it right now, you ultimately intend to go back there. So that is your domicile. The second rule for domicile is that your domicile, you can only have one domicile at a time. Although remember, when we're dealing with state taxes, that doesn't mean that California and, let's say, North Carolina are going to agree on where you're domiciled if you have links to both. And yeah, we could have different court decisions, so we'll ignore that side. But the one key rule is you cannot give up, if once you're domiciled in a location, you don't give up that domicile until you establish a new one. And the burden generally is on you to establish the new one. But it is a facts and circumstances determination. And what we have here is they found that he was domiciled in California based on two key factors that outweighed his Nevada formalities. His wife and his daughter resided in California homes he purchased for them. The maintenance of a marital or familial abode is a significant factor. It was true that they had separated very shortly after the child was born. And they eventually got divorced. But nevertheless, for these years, he was married and he had a kid and wife who was living in California in a home. The other problem he had, which is a big one, and states do this, they will check these things. His credit card data, he showed he spent overwhelmingly more time in California. 144 days they could establish he was in California based on use of the credit card, versus 13 days in Nevada in 2013. And what they do is simple. Credit card records, if you go ahead, let's say it's your personal credit card, and you take it out and you use it at a, let's say a dry cleaning establishment, in California, and it was physically present card transaction, then presumably you were there with it, right? And therefore you were in there that day. And so if let's say for a long series of days, we have tons of transactions in California and none in Nevada, well, pretty much establishes that you're in California. And again, 144 days they could establish he was in California through use of the credit card versus 13 in Nevada. That suggests that Nevada was really someplace he was at kind of on rare occasions, not nearly as often as he was in California. Now, once you're established to domicile in California, which is the first test, we go on to look whether your absences were permanent or temporary. And because that's important. If you're domiciled, if you have a, kind of quote, permanent absence from California, then you still could be treated as a non-resident. Now, that's an interesting concept, but it is under California law. But they look at closest connections cases to see whether you were really permanently out of Closely or whether, no, it looks like you're really closer tied to California. And they said the high percentage of physical presence in the state, substantial California real estate holdings, those are way more, because he had multiple homes. It's not just a home in Henderson. He had other homes, and those homes, the bigger ones were in California, right? And they were more significant than formalities like getting his driver's license in Nevada. You hear that one all the time. Well, get your driver's license. Yes, get your driver's license in the state you're trying to establish residency in. That's help. That's very useful. You better do it. But it's more going to harm you if you don't than help you if you do, right? And also that means you should not claim resident benefits in the state you're claiming you're no longer resident. I've had that conversation with clients, especially who are, let's say, moving down from Midwestern state and want to establish residence in Arizona because Arizona's 2.5% rate is, the lowest flat rate in the country. So generally much lower than rates in other states, regardless of whether, their actual rates they're paying. So you have these people say, well, that's great, but you always go fishing in your old home Midwestern state or hunting. And most of those states have resident and non-resident hunting and fishing licenses. It's not going to be good if you get a resident fishing or hunting license for the state you're telling me you're not a resident of. That will be an admission against interest problem. And you'll probably get nailed by both states in that case. And neither one will agree that, the other state should have taxed anything that wasn't directly connected to that state. So it can turn out very badly. We'll be that way, right? Okay. Substance over form. That's key. Residency is a substance over form. Objective factors of physical presence and family location will trump informal indicators like your driver's license or where your business is registered, right? Day counts are really important. And the franchise tax boards will use credit card data. I know that I've seen New York use cell phone records, right, to reconstruct physical presence. You got to make sure you have meticulous records. And if you're going to try to claim, as he did, I let my other, I let employees working for the company, use my cards. You better have real good documentation about exactly who used it and when. And hopefully somebody's willing to testify to that fact too in the case. By the way, also the Nevada businesses, his problem there was he did have Nevada business entities set up, but their mailing addresses were in Canada, which led the court to believe they're not really being run from Nevada, so that didn't help establish you were in Nevada. That was a whole nother set of problems, right? Now, he tried to get additional interest abated. While they had abated some due to delays, they hadn't abated all, he wanted more. The OTA took a look at the work logs. Staff was actually working the case during the periods he wanted additional. Yes, they took long, but they were working the case. You can't really delay itself is not sufficient if there is activity on the case. And also, family ties are key. If you want to be a Nevada resident, you better have the family there. And that, he did. The family was not there. The family wanted to be in California. They like the ocean, right? Ocean, right? Not much ocean in Nevada. Just saying. So that's also one of the keys. Okay, finally this week, we're going to take a look at a bankruptcy case. This is the case of Farber versus Feldman. This is Stephanie Paula Farber versus Lynn E. Feldman, debtor versus the bankruptcy trustee. This United States District Court for the Eastern District of Pennsylvania, case number 2:22-CV-01817. This is a case taken up to a district court, on appeal of a bankruptcy court's ruling in the area on September 5th. So let's talk about this history here. Now, this is the debtor. Stephanie's father passed away in 2017. She had an interest in a Prudential life insurance account, right? And she received $41,000. This Prudential life insurance account was an IRA. She received $41,000, which she used to open a new IRA in her own name at Wells Fargo, not inherited. Okay, that IRA was later rolled into a traditional IRA annuity with Alliance. Now, at that point, she files for Chapter 7 bankruptcy in 2021, and she claimed the Alliance IRA as exempt under Title 11 United States Code, Section 522 D1, right? So Title 11 is bankruptcy, right? We're in there. So the bankruptcy trustee objected, arguing this IRA was not a tax-exempt account eligible for bankruptcy protection. And there are a couple of problems with the account. We'll get there. Now, the court noted to be exempt, the IRA must be a fund or account that is exempt from taxation under the IRS. Okay? In 2018, the maximum contribution for Stephanie, was $6,500. She funded the account with $41,447. Now, the court found that initial Wells Fargo IRA was invalid from its creation due to a massive excess contribution, a defect that wasn't cured by later rolling the defective IRA into a new IRA at Alliance. The problem just carried over. And the court said in this interesting ruling that because the contributions triggered a 6% annual excise tax under Section 4973A3 of the Internal Revenue Code, that meant the IRA was subject to tax. Remember, we need a fund or account exempt from taxation. The 6% excise tax is a tax. Because the funds were subject to this tax, the account was not exempt from taxation by definition, and therefore could not be exempted in this bankruptcy. And apparently the theory would be, because you think, well, $6,500 should count, right? Because she had a right to put that in the account. And, the court is saying, no, actually, because the entire fund is tainted by the overcontribution. That's an interesting ruling because it could, if you apply that liberally, you're going to say that any overfunded IRA that pays the 6% ever, is that going to fail in bankruptcy? Well, again, it's not the fact here, so we'd have to wait for another case. Now, you might say, wait, but she inherited an IRA from her dad. The problem is inherited IRAs are not subject to the protection. The Supreme Court in the case of Clark versus Ramaker essentially held that inherited IRAs are not for retirements, right? The law meant a retirement account, dad's retirement account, when it comes to you, you're just kind of getting a windfall account. So it's no longer meant for your retirement. In fact, the law doesn't let you hold that to your RMD date. The law imposes RMD distributions on you at this point. And essentially, it's not just one of those things that's meant for your retirement. We're supposed to get the account out of there. Supreme Court said that doesn't qualify. Now, they did reject the trustee's argument that the contribution was a prohibited transaction of 4975. It did not meet the statutory definitions of it. Now, I think the trustee was worried the $6,500 was valid, and so was a little concerned about how to get their hands on it, because the court did say it was not an inherited IRA, right? She had put it in IRA in her name. Ones that she grossly overfunded it, but it wasn't her name. Okay. Now, the court said titling account as IRA itself is insufficient. It's got to meet the 408 requirements, all of them including contribution limits, to be valid. Again, little interested in wait isn't the IRA is overfunded. That doesn't terminate the IRA status, right? But and as district court held, it did. And her attempt to cleanse failed. You can't cash out deposit funds in a new personal IRA account to grant bankruptcy protection if doing so violates contribution limits. And an excess contribution, therefore, does not merely taint the excess amount. It could render the entire IRA non-exempt in bankruptcy. That makes this case a concern. Now, again, district courts are notorious for issuing bad tax decisions, not really understanding the Internal Revenue Code and not properly applying the rules. But not going to help you much if your client gets a judge who finds this decision and decides to go along with it. It would be helpful to watch to see if future cases, if we see this thing referenced elsewhere. Just to me, I don't believe it's probably worth to the debtor challenging to get her $6,500. Well, I guess with earnings maybe, but you understand at a certain point you're chewing up, you're just spending the money, so it doesn't matter. Whether it goes to the bankruptcy trustee to pay your debts, or it ends up going to being withdrawn and going to your attorney to pay the legal fees, may not matter if you don't have it. But it is a little scary that way because again, what if I just over-contributed by $100 accidentally? Does that blow up the IRA? And does it stay blown up if I withdraw the $100 after paying the 6% tax? At what point I apparently become subject if we don't withdraw it by the date we have to take it out? But it would be interesting conceptually to think of it that way. So again, a potential troublesome issue. Hopefully the courts ultimately will not be quite that, let's say, will not quite view it the same way. I really think it might have been better for the court to say substance over form. This is clearly still the inherited IRA, and you can't magically fix that because she never recognized the income. So she's treating it as if, so we're going to hold her to the fact she's treating it as if it was an inherited IRA and go from there. Well, that's been the Current Federal Tax Developments for September the 8th, 2025. As always, Current Federal Tax Developments are brought to you by your state society of CPAs. I'm around, maybe able to answer some questions. If you want to ask a question, you can email me, edzollars@currentfederaltaxdevelopments.com. You can also find me on the Connect groups for the Arizona Society of CPAs, New Jersey, Idaho, Illinois, Minnesota, Washington. So if you have questions there and I see the question, I think I can help, I may jump in. Otherwise, though, we'll probably be back here next week looking at more developments. Remember, we are rapidly approaching the first drop-dead due date of September 15th. So you might want to make sure that everything's going fine there. I hope you're surviving this because remember, right after you finish this, we go to the trust drop-dead date. And once we finish that, we go directly to the 1040 drop-dead date. Oh, you got any 1120s that are calendar year, we'll take them there too. So all of that's coming up. So in any event, we will see you next time here on Current Federal Tax Developments.